underperforming, it depends on their holding period. Now, this is a very new idea. This is a very new idea. Not many, or I don't know of anybody who has been talking about this. We are the only one saying that for one investor, markets can be outperforming and going up, and for the other investor, market can be going down, assuming he understands his holding period. Say, for example, somebody is playing for the last week in the Romanian market. And if somebody is playing for the last week in the local markets, and he may say that yes, the market is going up. But somebody who has a larger holding period and is sold near the high of 1.9 and say 5, 1.58, recent high of 1.58, for him, this SIF 5 may be underperforming. Now, it depends on how long somebody sees his holding period. So that is what we are trying to show in a time structure, that at every point of time, the markets can be outperforming or underperforming at the same time. And if we can build a system where we can understand when the markets are outperforming according to my holding period, and when markets are outperforming according to your holding period, we both can make money for our holding periods. Ultimately, what are you interested in? You are interested in that when you get into the market, you create some performance. I'm interested that if I go into the market, I may make some performance. But if our holding periods are different, you can also make performance and I can also make performance whether I am on the short side or you are on the long side. Irrespective of the fact which side we are playing, we both can make money if we understand our holding period and if we understand the structure of performance. And that's what I'm trying to explain you here. Okay, so for example, I was explaining here that for a certain period of time, the brown line can be going up, and for the same period of time, the red line can be going down. So the larger person is looking at underperformance, while the smaller one is happy with a few days of outperformance. So performance has is always moving. Performance is always moving. It is always pulsating. It's always giving an opportunity, and this is the possibility that there is always money to be made in the market, provided you understand how performance moves. Now, this is the kind of structure of time we highlighted. The time basically can be divided into by 3, by k by 3, k by 9, and time can also be multiplied by 3 on the other side, and it can increase k and 3k and 9k and ahead. So time, we were saying, had a structure, and this structure of time we were saying is the reason for performance having an order, or performance having a structure, because performance cannot be cyclical if time was not cyclical. We cannot assume performance to be cyclical. So we somehow are trying to prove that time is cyclical, because of which performance is cyclical, and because time is cyclical at all degrees, that is why performance is going up and down in the intraday market, and it's going up and down in an end of day market, and it's going up and down in a multi-month market. So every time performance is going many months up, many months down, many weeks up, many weeks down, and it's a crisscross of performances that gives a lot of opportunity, provided we understand whether the performance is up now for my holding period or the performance is down now for my holding period. If I do not understand my holding period, which is also a kind of, if I don't understand my risk, then I cannot understand, or I cannot be in the 20% of the people who can create consistent wealth. So this is what we are saying, that there is a, like Pareto said, in price there is a structure, or in wealth there is a structure. We are saying that in time there is structure. That means 80% of the time markets do not make a big change, and in 20% of the time markets make a big change. So if you were selling from Uno Varga change oak to Uno Varga trace change, you made money. But if you were in the every day in the market for the last 2 months and you missed the move of 1.58 to 1.3 change, then you did not make money, because the big move only happened in a few days. In a few days, in a week or so, market came from shift change came from Uno Varga change to Uno Varga trade change, and this move was very fast. So we are saying the real move happens very fast. That fast means that the real move happens in less time. So in the 80% of the time, market doesn't move. You sit on, you are patient, and you're watching television and seeing the screen and waiting for the prices to buy or somebody to make a move, and markets go to sleep. And 20% of the time, when you are on leave or somewhere traveling, market moves. So the whole understanding is that if we could have a system to know that when markets are going to move, then we can understand the real activity. And when we can understand the real activity, we can trade that activity or invest in that activity. And when we can invest in that activity, we can make money. So this rule which he said about Pareto in price, we were saying also happens in time. That means 10 months out of 12 months, you can be on vacation, and 20% of the time, 2 months is what you have to really trade. So you could afford a life where you are trading only 2 months of the year and preparing for the rest 10 months and doing other things, or having fun if you understood that time when the action is going to happen. So this is what we did on one of our first papers, where we talked about the time fractal structure, which is published now in the Social Science Research Network, where we were explaining that even the most correlated assets like Chevron and Exxon, which is 99% correlation, one can understand when to buy Chevron and when to buy Exxon. So one could buy Chevron, sell Exxon, and still make money if he understands how the performance is moving between Chevron and Exxon. So we just made a ratio of Chevron Exxon, and we did a rate of change of that Chevron Exxon, and we did it for a weekly time frame, we did it for a daily time frame, we did it for shorter time frame, and consistently we saw that there was a there was a three-way structure, a triangle structure. So this three triangle structure was visible at a smaller degree, at all degrees. And when we just plotted the lows and the lows of the time, and we calculated the difference between the calendar days. Say for this day happened on October, this happened do 5 May. So 5 May do minus 10 October now gives me some days. And I took out all the days between the signals, and when I plotted them in a simple descending order, I got the same Pareto curve, which is a similar looking curve. So I started to understand that there was a clock in the price which was linked with time, and if I could understand time, I could understand performance. So this is how we started working on pairs, and we started testing the lows visually, and we started showcasing, illustrating money between 0.99 correlated assets like Chevron and Exxon. And this strategy, as you can see, there is only 1/10% fall that happened loss that happened between Chevron and Exxon, but otherwise this strategy delivered about 56% annualized return. So this is how we started to work on the structure of time, and we also now I want to show you what I mean with the structure of price. Now, price may be believed to be influenced by news and fundamentals and demand supply technical sentiments. Markets can be influenced by many things, and we study so many things. But if we look at a market structure of a day, just if I just plot the performance of bet components or bet XT components, and I draw all of them together, and I can see that there is a kind of curve that I see. Some stocks give much returns, much high returns, and some stocks give much low returns, and 80% of the market or most of the market is moving very less. So this was the structure of price which Pareto unknowingly highlighted. He only highlighted in wealth, but today that's a rule which we call the power law rule in prices, and it is happening in every prices in every exchanges around the world. And we cannot say that local markets are small. Even though they are small, they still show the same exponentiality which Pareto highlighted in 1920. So this is a kind of curve which is, you see, this is a similar curve to Pareto curve. It is not very different from what he highlighted, but this is from the stock exchange. He was highlighting in wealth. This is from the stock exchange. But this continuously, whether you take 1 day of performance of all the stocks, just put a 1 day performance of all these portfolio stocks that you cover, and you will see that this is the formation that will come. Whether you do it for 1 day, you do it for 1 week, you do it for 1 month, you do it for any time frame, you will see the same curve. How can market be so structured? Market is structured, it's just that the science is not popular. It is an old science and it is known in academic circles, but it is not very popular among investors. So the market had a pattern, price had a pattern, it was not chance, it was like a curve. Was the curve mathematical? Yes, the curve was mathematical, because if it was happening on 1 day, or whether it was happening on 5 days, whether it happening on week, we could see that though there was news and there was information and there was all kind of information that we see in the news, despite all the information, all the news connected to stock market, not connected to stock market, influencing the stock market more or influencing the stock market less, or some information connected with risk or bankruptcy of banks, anything you see, but the market structure was still the same. Month to day, similar structure on month to day, and if we say few weeks, so it was an order. Now this order I am not seeing today, and it was not written yesterday. It was written in 1923, and you can see it yourself. Look at SIF 5 prices. If you look at SIF 5 prices on 1 day return, 5 day return, monthly return, quarterly return, yearly return, historical return, if you put all the return in an Excel and you sort them ascending to descending, you will get the same curve. So the idea is that there is something driving SIF 5 which we are not aware of. And what is driving SIF 5 is basically the Pareto curve. That's a rule of law. Pareto did not know why this rule worked, but he said, wow, this is a fundamental driver for men, and which I do not understand why it works, but this is amazing. This is wondrous. So we are saying that though he could not find it, but this, if we can prove in time and if we see it in time, then now we understand that why prices are behaving like this, because time, if time is mathematical, everything will be mathematical, including SIF 5. So this is a 6-month structure. You form the local market, you see the similar structure, and if you see few months, you see the same structure. Nothing really changes it. News, demand, supply, technicals, fundamentals, mysterious force, earthquakes, tsunamis, the order remains the same. 1 year structure. So I am saying that this was not only in the local market, but this was also in the similar SIFs also, SIF 1, SIF 2, you draw and you will see similarly a similar curve that goes too down on the loss side, it goes too much up on